Good afternoon. In this video, I want to provide some guidance on the accrual-based accounting. We will go through the process of adjusting entries at the end of the period. We want to make the distinction between deferrals and accruals. Deferrals happen when cash is received or paid prior to the expense or revenue. For example, a deferred revenue would be unearned revenue. A deferred expense may be prepaid insurance. An accrual is where revenue is earned or expenses are incurred prior to the actual receiving of cash or payment. In this case, we're going to see accounts receivables or accounts payable or some other liability account. In this video, we're going to focus on the adjusting entries that occur at month end to adjust the balances based upon activity that occurred during the month. Before we walk through the adjusting entries, let's make sure that we understand where we are. If we go to the balances, you notice that we have a line here where cash is $7,730, accounts receivable is $1,900, prepaid insurance $8,400, and so forth. These are the transactions that occurred during the month. What we're doing in this video is going through specific adjusting entries to adjust for activity that occurred. The first adjusting entry relates specifically to prepaid insurance. We talked about prepaid insurance as being this item where we pay for insurance in advance, and as we do this, we have a prepaid insurance asset. This is a resource that is available to be used. As we consume this resource, we then have an expense. The expense essentially represents a decrease in prepaid insurance. So in this case, what we have determined is that during the period, $1,100 of insurance has expired. Therefore, we are reducing prepaid insurance and then creating an expense, and the expense is insurance expense. This has no effect on the statement of cash flow. The income statement amount is an expense, and the expense again is insurance expense. Given the fact that it is an expense, the item is a reduction in our retained earnings. The next adjusting entry relates to supplies. As supplies are consumed, these supplies, which is an asset account, are transferred to an expense account, and that expense account is supply expense. Generally speaking, what takes place is that at the end of the period, we do a physical inventory count of our supplies. In this case, we did a physical inventory count of our supplies and found that $90 worth of supplies remain on our shelf. Given the fact that with the beginning balance plus purchases, we had a balance of $240 and $90 are remaining, we know that $150 of our supplies were consumed. Again, the supply account is an asset. This asset is a resource that's available to be used. Once this resource is used, it becomes an expense. So in this case, $150 of the supplies gets removed or reduced from our supply account and moved to our supply expense. This adjusting entry does not have an effect on the statement of cash flow, but our supply expense is reported on our income statement, and given the fact that it is an expense, it reduces our retained earnings. Before we go through the transaction related to depreciation, I want to spend a few minutes talking about the concept of depreciation in the financial statements. As we purchase fixed assets, including equipment and buildings, we are reporting these as an asset. However, these assets are consumed over time. What we do on the financial statements is we report an accumulated depreciation. The accumulated depreciation represents the consumption of this asset. The accumulated depreciation is a negative amount. However, it's reported on the asset side of the balance sheet. This is what we call a contra asset. The asset account represents a reduction in the underlying asset of the equipment or building. As we report our accumulated depreciation, we are going to report a depreciation expense. This depreciation expense represents the consumption or the use of the asset for the period. The depreciation expense is an expense reported on the income statement, as well as a reduction in retained earnings. However, depreciation is not an item that affects the statement of cash flow. So now let's look at a depreciation transaction. In this case, the depreciation on the office equipment for family health care is assumed to be $160 per month. We create a negative contra account, which is accumulated depreciation. This is $160 and negative $160. This is then reported as an expense of depreciation expense. And again, given the fact that this is an expense, the item is reported as a reduction in retained earnings. At the beginning of the month, a company had rented our land for 5 months, and they paid us $1,800 in advance. You notice that we have $1,800 as our balance before the adjusting entries. This balance is in unearned revenue. It was unearned because the use of the land represents time, and at the point when they rented the land, no time has expired. The rent was for 5 months. 1 month has expired since the payment. Therefore, we are reporting 1/5 or $360 of revenue. So in this adjusting entry, we are reducing unearned revenue by $360 and increasing retained earnings by $360. We're increasing retained earnings because this is an example of revenue, and it is reported as rent revenue in our income statement. In our next adjusting entry, we are dealing with the concept of wages payable. In this situation, which is very common, is consider the fact that a company pays their employees every 2 weeks. The reality is that the 2-week mark does not necessarily end at the end of the month. Therefore, when we pay, let's say we pay on the 3rd of the month, some of that payment represents resources that were used or employee expenses that were used for the prior month. We need to adjust at the end of the period for the amount of resources that we owe to employees up until the end of the period. We do this with a transaction that we call wages payable. In this case, we determine that $220 of wages were consumed during the month but not paid. Therefore, we're going to create the liability of wages payable. Given the fact that these are resources that were consumed, we have a wage expense. And given the fact that this is an expense, this represents a decrease in retained earnings. This does not have an effect on the statement of cash flow. Let's look at the final adjusting entry. This final adjusting entry is an adjustment for services provided but not yet billed. So in this case, family health care provided services worth $750 to patients. These services have not yet been billed at the end of the month. Let's assume that the company accumulates their accounts receivables and bills these as of the 5th of every month. However, some of these billings represents services that were performed in the prior month. What we need to do is we need to account or accrual for these transactions because they were completed. So we are creating an accounts receivable. In this case, the accounts receivable is $750, and we are reporting revenue of fees earned of $750. This also represents an increase in retained earnings. As we've gone through these transactions, you note that we are focusing on the adjusting entries. These adjusting entries are specific to accrual-based accounting, and we have talked about deferrals and accruals. I thank you very much for your time, and I'm looking forward to our next discussion.